Company in Malaysia are those entities incorporated under Company Act 2016 or under Company Act 1965. An entity can be incorporated as company when one or more persons register the company for any lawful purpose and comply the registration requirement of the Company Commission Malaysia (CCM). There are three classifications of company. Number 1, company limited by share. Number 2, company limited by guarantee. And number 3, unlimited liability company.
So, Assalamualaikum and hi everyone. My name is Harfina and I'm going to tell you about types of companies in Malaysia. In Malaysia, we have so many types of companies such as public company, private company, government linked company, exempt private company and foreign company. So, the first one I want to tell you about public company. Public company have the word Berhad at the end of their name, such as Syarikat Air Johor Berhad. Unlimited shareholders. Limited liability. Limited liability is about if creditor can take their capital only, not their individual asset. So can offer share to the public. They can raise their capital by selling share to the public. So last is disclose their financial statement. Example, TMB and SAJ. Next, private company. Private company have limited liability by shareholder. Total member does not exceed 50% and they cannot transfer share easily. Cannot offer share to public. Private company and public company is different. Okay? Exempt private company. Exempt private company is company not exceed 20 members and no corporate shareholders and whose share are not held directly or indirect by any corporation. And they also not file their financial statement to register of companies provided, such as Falcon. Foreign company is usually outside, usually a company, corporation, society, association or other body that incorporate outside Malaysia, or they can sue or can be sued or hold property under the law of its place origin. They also does not have head office in Malaysia, and they under Division 1 of Part 5 of the Companies Act 2016. The last one is government-linked companies. Government-linked companies is government owns some of all share capital. They also can be private or public company, such as TMB, Tenaga Nasional Berhad. They are public company but also government linked.
The main information required for incorporating a company are the first one is the name of the company. Second, status of the company, whether the company is private or public. Third, nature of business. Fourth, registered office. Fifth, name, identification, nationality and residence of the director. If your company limited by share, the main information required is the detail of class of share and the number of share held by each member. If your company limited by guarantee, the main information required is the amount the member undertakes to contribute to the asset of the company in the event of it being wound up.
My name is Mohammad Farhan from the A4C. So today I will present about financial reporting requirement. So the secondly is the financial statement. These financial statements are to be duly audited before their distribution to the members and before the AGM. It should have true and fair value of the financial reporting of the company at the end of the financial year and financial performance of the company for the financial year. So lastly is the director's report. Based on the section 252 of Companies Act 2016, state that the director report requires to be attached to the financial statement of the company. It may also contain the business review. So that's all from me. Thank you.
In annual report, we have chairman statement, corporate government statement, statement on internal control, audit committee report, social responsibility statement, and the last one is financial statement.
All the listed company in Bursa Malaysia has to make additional disclose regarding to the performance of their companies. The listed companies are required to make a preliminary statement of result within 6 months following the end of their financial years. The listed company are to issue half-yearly report regarding their performance within 3 months following the end of the half year.
Lee is the overview of who is the owner of a company. So the secondly is access to funds. So what is meant by the liability protection? It is mean that there is zero risk of losing the personal assets from the company. So next is continuity. Last but not least is increase in credibility. It is because they have a new environment of work that can give them. So the first one for the disadvantages of changes of partnership into a company is state feelings. So the secondly is tax. The procedure for formation is to be formal and written. But the financial report has to audit by the certified auditor. Lastly is the cost of registration fees for a company.
Okay guys, difference between partnership and company. Firstly is capital, which is partnership. Everything is come from the partner. The more partner in the partnership, the more capital they have. Okay, but for company, everything is come from the shareholders, which is comprising a number of categories such as capital, retained earnings, other earnings, and capital reserve. Okay, next is profit and loss. Profit and loss for partnership is divided into the capital account of the partners according to the agreed ratio. But for company, they need to divide by 2 shareholders, which is ordinary shares and preference shares. Okay guys, let's proceed to income statement. Set up for whom? For partnership, income statement is set up scheduled for the distribution of the profit or loss to the partners. But for the company, they set up for their shareholders. Okay guys, let's see about taxation. Taxation for the partnership is on the individual partners, but for company is imposed tax as is it a separated legal entity. Okay guys, partnership also have balance sheet that shows the balance of capital amount of each partner classified under the equity of the owner and also the company. They show a statement of changes in equity where changes in share capital, profit, revenue and other capital reserves during the year. That's the difference between the balance sheet and statement of changes in equity.